Thank you everyone for joining in our first ever digital summit series, helping customers recover after a financial crisis. Today, I just want to introduce myself to start off with. I will be your moderator. I'm Janine Krish, and I'm the marketing director at Flybits. The COVID-19 pandemic has really been one of the most serious threats to the financial services industry in the last 100 years. While it's really devastated people on an individual personal basis, as well as economies around the world and businesses. And while we don't know what's necessarily coming next, we do know that things are likely never going to go to what they were pre-COVID. So this creates a unique opportunity for the industry, an opportunity to reset, to reinvent your business, and to truly rewrite the playbook. The businesses that are going to come out stronger will be the ones that are truly able to become a gateway of trust with customers and take a purpose-driven approach to banking. Today's guests include Flybits CEO and founder Hossein Rahnama and Accenture's global banking lead, McIntyre. So the way this is going to work is they're each going to speak for about 15 minutes, followed by a few questions. And then we're going to turn it over to the audience, and you can ask your own questions. So feel free to use the Q&A box at the bottom of the screen. So allow me to introduce Hossein to start off with. Hossein, it lives at a unique paradox between academia and entrepreneurialism. He, in his spare time, is a visiting prof at MIT's Media Lab, as well as Ryerson University in Toronto, where he happened to co-found the biggest university incubator in the world, the DMZ. At 35, he was named one of the top 35 innovators under 35 by MIT Technology Review. And in 2012, he was named one of Canada's top 40 under 40. So that should give you enough information to calculate his age. Hossein is also serving as a board member at Capital Group and Canada Science Publishing. His passion is to empower young entrepreneurs. On a lighter note, he plays the clarinet and the piano. He loves the blues. He is also a lover of aviation, is a proud father of 2, and is a strong and fearless leader at Flybits. So without further ado, I'd like to pass it over to Hossein. Whoops. Let me give you control, Hossein. All right.
Thank you very much, Janine, and thanks everyone for joining our webinar. I'm hoping everyone is healthy and well during this pandemic period. What we like to talk about today with my friend Alan is to really share our views on how the dynamics of COVID-19 is changing banks and the opportunities that it creates for them to play a way more important role in the well-being of our society and also rebooting the economy when the pandemic is over. You may have all seen the news that the physics of this virus is as such that it mutates. And we are trying to figure out what it does, of course, to our well-being and to our health, but also we think it has a mutational impact on the organization of a bank. What we will be talking about today is how this new dynamic changes the organizational aspects of a bank, the technological stack and the elements of a bank, and also how it creates opportunities for banks to think about new business models. One of the key things we will spend some time on today is the acceleration of digital transformation at banks. You may all heard about this notion of digital transformation strategies that banks want to bring data from inside the bank, outside the bank, understand their customers better, provide better automation within the bank. And usually these have been multi-year initiatives. And one thing that we have observed so far is that banks are trying to deliver these strategies within months rather than years. We will talk about the importance of personalization and what our view is about personalization and its importance. And we'll talk about the organizational changes that we are seeing in financial institutions. When it comes to the dynamics that are surrounding banks, you may all have seen that branch networks are becoming more and more ineffective. There is this lack of interpersonal communications between financial advisors and people. This situational understanding that branches were known for is no longer there. So the key question for leaders is, well, how do I bring that context, that intuition now into my digital channels? How do I show that I still understand my customers and leverage the digital channel as my new branch? We are also seeing that banks are becoming a conduit and a proxy between people and the government. And I think this is an opportunity for banks to play a more important role in the well-being and the health of their customers. And banks are also going through some key changes in terms of their internal working dynamics. A lot of people have to work from home, call centers need to operate remotely. And these are, of course, it's terrible what's happening in the world, but it's also a catalyst of change for banks to transform themselves faster than what they originally intended. The other thing that is happening in the industry, as I'm sure you know, is big tech firms are also becoming banks, from Google to Facebook to Amazon. So the key questions for banks is, well, how do I stay relevant? I still have a lot of data about people's income and transactions, and if big tech have access to those data sets, then my business model will become more prone to risks. So this is also where we see as an opportunity in which banks can form alliances, not just among themselves, but with complementary businesses to introduce new business models to prevent that disruption, but also create new business models based on the notion of trust to be able to deliver better services to their customers. In terms of what we are seeing in digital transformation, before COVID-19, when we talked to a lot of our customers, they had a lot of moving pieces as part of their digital strategy, from data security to distributed ledgers to edge computing to moving to cloud. And these really kind of followed a siloed way of progressing. What we are seeing in banks now is that they are now solidifying under one unified umbrella, and then there is a lot of speed in banks to bring them in the market as one transaction medium. And as you know, data and digital is becoming more like a must-have rather than a nice-to-have, considering what's happening to the world. The other area that we are observing is the emergence of, we call it confidential computing. Now that banks are playing a key role for supporting people with their financial health, with loan deferrals and many other things, keeping their data secure and doing data processing in a privacy-preserving way is becoming more and more important. So one area of focus for us at Flybits and with a lot of our partners is to do data processing and personalization while the privacy of the customer is protected. So there will be a lot of things that is going to happen in the market around confidential computing. As I'm sure many of you have observed, over the past 5 years, there were lots of discussions around AI, and AI meant different things to different people. A lot of people relied on AI as a decision maker engine to make decisions for the business. And then there was another school of thought that AI can actually be used as a decision support mechanisms. And then the end decision can be made by humans. Within Flybits, our view is that because of COVID-19, AI will become more prominent in a lot of the strategies, but it will act as a decision support tool. And not in a pejorative way, but we have all seen companies, small and large, that they talked about AI and they could not differentiate what a basic linear statistical model is versus a true AI. So I think a lot of those will disappear, and AI will truly find its position in financial sectors as a strong decision support tool. The organizational changes that we are seeing is usually when you look at the anatomy of a bank, it has an IT group, a digital group, recently a data science and an AI group. And before COVID-19, we saw that there was lots of disconnects between these entities and sometimes even competitions. Now I think what's going to happen, because senior leaders and executives are understanding more and more the importance of digital, they're unifying these teams together. So there are stronger collaboration between these teams, and digital and IT are acting as a horizontal function in banks rather than just a silo. And we are actually writing a paper about this, that how the two-dimensional org chart of a bank will transform into more like a circular view and a circular paradigm of collaboration. The other thing that we are observing is banks are starting to look more and more for interdisciplinary skill sets. When I finished grad school and my background of research was in machine learning, it was very difficult to imagine that a bank would go and hire AI experts and later on designers and UX experts. One thing that we think will happen is that don't be surprised if banks starts to hire a lot of statistical biologists or pandemic experts to add to their teams, because they require a better understanding of these physics and dynamics to make better decisions. So I think that is also a key change that we are observing in the market. When we look at the business model changes, if you look at the current kind of core functions of a bank, they look after your money, they help you to pay for things, they provide loans. And in general, as a bank, they are being assessed as based on their assets under management. I think the bank of the future, of course, is doing a lot of the things that the current bank does, but they also play a role in helping their customers to live a better life. They can predict their needs. They can act as their trust hub, so that instead of just the customer depositing their financial assets with them, they can also deposit their data assets, and the data will play a role to help the well-being and the health of the customer. Some of you may know or remember the Weir Bank from Switzerland, on how during the 30s and the depression and the financial crisis, the Swiss government created this notion of Weir Bank that especially for SMEs to contribute to the growth of the economy. And we think the same thing will happen again in different parts of the world, but the unit economic of these banks will be data, and how they share data to create network effects and create value for the community. So there will be a huge emergence of community banking and SME-driven banking based on the crisis that we are seeing. Now, to dig a little bit deeper in the three areas that I talked about around digital transformation, we see some very unique things happening in the market. One, of course, is the importance of personalization. And personalization, not just based on financial data or transactional data, but the ability of correlating internal financial assets with external contextual data and come up with better decisions. And that's why we call it multidimensional personalization, because a lot of the vendors and banks that we see in the market, they are very good for processing passive transaction data. Whereas we think in the absence of branch networks, the dimensions of data that you need to do true personalization goes way beyond that. We will see a huge emergence around tokenization of data because of privacy, because of sharing of the data. And of course, the emergence and the acceleration of cloud deployments. Not that banks will put everything in the cloud, but they are going to come up with ways to keep some of their sensitive data in their premises, but use cloud for processing in a secure and privacy preserving manner. We are actually working with some of the largest banks in the world to help them to form alliances. So for example, partnering with medical centers, partnering with airlines, partnering with utility companies, and through that alliance, deliver better services to the customer while the privacy of the customer is protected. And in order to do that, a very important element in digital transformation is the availability of edge computing, that the data won't be stored in a centralized repository, but let's say it can be calculated on your personal phone, similar to how you hold your photos and music on your local device. And of course, the emergence of AI as a decision support system, emergence of confidential computing, similar to what companies like Microsoft with Azure and Intel with SGX are doing. I think those are going to be the emerging trends that we will be seeing in the market. In terms of the customer engagement, or digital customer engagement, which is going to be a key priority for banks all the way to CEOs and boards, the question becomes, well, what type of a digital engagement that we need? And in the market, there is a whole spectrum available, from very generic engagement, let's say as emails, all the way to AI-driven contextual engagement. And there are lots of capabilities and vendors available that are providing different aspects of this spectrum. But what is missing in the market is the lack of context. Banks need to understand how, when, and through what mechanism and medium they can communicate with that customer. If I'm reviewing my emails at night, perhaps that's a good way to engage me. Whereas if I'm going for a walk and I'm busy, perhaps I need another way of engagement. And one thing that Flybits does very well is that it understands which context of engagement is needed, and then it will use the right channel and the right context to communicate with that user. So we are working with a lot of our customers to help them to put the spectrum of engagement in place and then understand the context of the customer to communicate with them more effectively. When it comes to, we just go to the next slide. Let's see. One of the things that we are also seeing is, as part of the organizational changes, is in order to do impactful and privacy preserving personalization, the dimensions of the data are of course important, but the organization and the structure of the organization also matters. And we are working with a number of our customers and other entities to help banks to figure out what the new dynamic of collaboration is going to look like. So unlike what you're seeing on the right-hand side, instead of having levels and levels and levels of hierarchy, we are helping banks to create this notion of agile interdisciplinary teams to collaborate, leveraging the data. And what you see in the middle, a lot of the personalization activities and vendors that we see in the market are doing that based on just one dimension of the data. Let's say primarily transaction data or income level, or very, very passive transactional information. I think in order to do personalization right, you need to think beyond that. You need to bring, health data, movement pattern data, agentification of the data, sensory data. And I'll show you an example at the end of this presentation that how we are helping one bank to actually help their customers with contact tracing and managing the COVID-19 crisis. So in order to do personalization, you need way more than just transactional data, as most PFM companies do in the market. The other thing that we see in the market is the formation of alliances between banks. If you think about the relationship of a bank with their corporate customers, is very much bilateral. So a bank working with a telco, a bank working with a retailer, a telco working with a retailer. And one thing we are seeing based on the physics of data and what also COVID-19 is doing to the industry is that a lot of the classical industry verticals will disappear. You're already seeing in the market that, let's say, a retailer is going into the hotel business because they understand the retail pattern of their customer and they create a hospitality experience for them. And with two of our customers in the US, we are actually helping them to position them as a hub of connecting a lot of these complementary businesses together, from a utility company to a supermarket to even an academic institution. And through an opt-in process, the customer will share their data on an aggregated basis, and they will receive way better information through their banking channel to live a more effective and a healthier life. Last few things I mentioned is that through this partnership that we are helping banks to form, we are observing this new physics of data, that when they bring one or two partners around the bank and they correlate the data and use that to engage the customer better, during the early days, we are not seeing a lot of value. But as they have 3, 4, 5, 6 partners, the impact of personalization will start to grow exponentially. Because the more we correlate data sets that in the past could not come together, we are seeing that we can find patterns that even we could not think of before. And that is helping the financial institution to make better decisions. And these data sets can come from a realtor. We are working with a lot of real estate players on the internet to bring, let's say, open house data. We are working with telecom operators to bring movement data on an aggregated basis. We also partner with energy companies to understand energy consumption, and we are helping the bank, not just as a financial vault, but as a data hub to understand these data patterns, and with the permission of the user, engage with them on recommendation and predictions. And we are seeing a lot of value in that, not in terms of what we can do as a technology company, but also what the bank can do to transform their business models. So my last few thoughts is we are seeing that there are two thoughts in the market. One is banks will get rid of their branches completely. The other thought that we are currently hypothesizing and building is that actually we think branch networks will stay, but they will get repurposed to become this hyper-local trust hubs for community. So it based on some sort of a token economy, they contribute to the health of that community in terms of helping SMEs, allowing that community to invest in their local businesses, measuring the health of that SME and really making people participating in the health of their community. So that's a very interesting things that we think branch networks will evolve to. And we talked about, the formation of data alliances in the bank, which are kind of some of the new business model changes that we see in the industry. The last thing I mentioned, just kind of wearing a bit of a selfish hat on Flybits, we are working with about 25 very large banks around the world, and we help them to put our recommendation engine on their digital channel, that while we are getting a lot of data for them, we make sure that they are privacy preserved, and then we surface these information and recommendation for them on the channel. And one of the unique things that we pride ourselves on at Flybits is that we walk the talk. And this is a very quick demo that I wanted to show you, that it shows how in real time a bank can bring data from inside and outside the bank, leverage semantics and ontologies to make sure the data taxonomy is being built properly. And in this particular case, let's say, manage a machine learning risk model to target customers who are low risk, let's say on defaulting on their loan, combine that with some of the recent transaction data, and also go and tie it back to some external data asset, let's say in partnership with an airline, to figure out if a customer has been at a high-risk airport, such as the LaGuardia, if they have been in contact with someone who have tested positive. We got that data from health authorities in our country, and also some contact tracing information using an initiative that we are building at MIT, and bring all of that information together to deliver some very unique, useful information to the customer. As you can see here, it's not just about telling someone that you spent too much on coffee or your bills are due, but it's really using transactional data to turn the digital channel of the bank to a true recommendation engine. And with that, I'll wrap up my presentation and pass it on to Janine. But these were some of the highlights wanted to share with you that we think banks of the future will be assessed on their data network. There are lots of talks about AI, but we actually think a data strategy is way more important than an AI strategy, because AI without data really doesn't mean anything. We think COVID-19 is, of course, terrible, but it's the strongest transformation agent for financial institution to change. And we actually think the new executives that we see at banks are coming from very different backgrounds, let's say physics, data science, and those are some of the new trends that we are seeing. So with that, thank you very much for joining us, and looking forward to the rest of the discussion, and of course hearing from my good friend Alan and what some of the great things that they are doing at Accenture.
Thank you very much, Hossein. That was a very insightful presentation. We only went 7 minutes over, so with such a big topic, you know what? I think what we're going to do is hold questions for the end, and do more of a panel style discussion. So now let me introduce Alan McIntyre, who heads up Accenture's global banking practice, which covers all aspects of their work in retail and commercial banking, payments, and consumer lending. He has spent more than 30 years helping financial service organizations adopt new strategies, technologies, processes, and skill sets to improve and grow their businesses. But his interests extend far beyond banking alone. He has a passion for classical music and is chairman of the Stamford Symphony Orchestra in his home country of Scotland. He is a patron of the Institute of Contemporary Scotland and has been inducted into the Global Scot Business Hall of Fame. In the pre-COVID past, Alan was also an enthusiastic and tireless traveler and is well known in the Accenture world as the Flying Scotsman. So without further ado, I will pass it over to Alan. Give me a moment while I set up his presentation. All right. Let me give you access, Alan. You should have access any moment. And let's present. Okay, there we go. Over to you, Alan.
Thank you, Janine, and thank you, Hossein, for allowing Accenture to be part of this event today. So let me talk a little bit about what we're calling purpose-driven banking. This is going to pick up and amplify some of the points that Hossein has already made. But if I look at the last 8 weeks, one of the things that I think characterizes a lot of the conversations that I have had with executives in the banking industry. So Janine, have you given me control? There we go. One of the things that has characterized a lot of the conversations that I've had with C-suites in the banking industry has been regret. It's been regret that in what you would think of as more normal times, even just a few months ago, that financial institutions did not go quicker in their transformation efforts. Regret that, with the benefit of what is now 2020 hindsight, that they weren't more digital and data driven, that they hadn't moved more to the cloud, that their cost structure wasn't truly variable. When you look at the maturity of sales on digital platforms, they were not end to end. That there was still too many people involved in key processes, and that with hindsight, they found themselves still buried under legacy IT debt. So I think that there has been a recognition and a realization that maybe there should have been more changes when there was both the time and the financial resources to transform a little bit quicker. But regret isn't going to help us going forward. So I think when we look at the what comes next, there are certain things which are known. What we know, picking up on what Hossein said, is there are going to be fewer bank branches. There were already fewer bank branches. If you look over the last sort of 5 years or so globally, well, there were still markets like, say, India, where the number of branches were increasing. Globally, we were looking at a 3 to 4% drop per year in the number of branches. It was certainly far quicker in some markets than in others. And I think what we're going to see is we're going to see an acceleration. I spoke to the CEO of a leading bank in the Middle East a couple of weeks ago, who had essentially closed all the branches and was talking about maybe only reopening 20% of them. We're certainly going to see more digital interactions. Clients that I speak to have seen their digital mobile interactions go up 50 to 100% over the last few weeks. Partly that's because maybe branch networks haven't been available. Partly it's because some institutions have a 3-hour wait time in order to access call centers, just because of the deluge of people wanting to talk to their financial institutions. So we've certainly seen that there's going to be habitual digital interaction. Psychologists will tell us it takes 60 to 70 days for consumers to form a new habit. We're going to be at that 60 to 70 day point relatively quickly. And once people have educated themselves and got used to doing things online and through digital, many of them will never go back. But certainly we're looking at an environment going forward where there's going to be significantly more financial stress. We're at the end of what's been a decade-long expansion. And whether the recession that we're looking at lasts 2 quarters, 3 quarters, 4 quarters, there's certainly going to be a very different tinge to the interactions that consumers and small businesses are going to be having with their banks. There are going to be tougher times ahead. But I think if you draw the comparison here with 08 and 09, this crisis is an opportunity for financial institutions to be heroes rather than villains, to be part of the solution rather than the problem, and to mitigate and to rather than amplify the financial stress that a lot of bank customers are going to be feeling. And I think that there's going to be a real onus on banks to help their customers navigate through what are very uncertain times. And there are many things that are unknown. One is this a one-off, or is this a recurring public health crisis? And how does that then flow through into the shape of the economic crisis that is generating? You can play the alphabet game here in terms of what the shape of the recession is going to be. But I think one of the key things is the balance between public sector and private sector support. I was looking at some macroeconomic analysis from Goldman Sachs over the last couple of days, suggesting that at least in the US for the next couple of quarters, what is coming from the public sector is going to offset what is coming from the private sector in terms of income. And while there will be a recession as output falls, the spending patterns coming out of it may not be impacted that much. But the question is, if we are in a 3, 4, 5 quarter economic recession, at what point does the public sector money run out and the private sector in the bank balance sheets have to pick that up? And that will help determine whether we're looking here at a speed bump or whether we're looking at a solvency crisis for financial institutions. So I think that there is a lot of things which will change, and we are confident will change going forward, but a lot of things which are unknowns and which will help shape the nature of how banks are interacting with their customers. And I wanted to make a point here about the good old days. The good old days being 2019. I think that there will be a little bit of a tendency to view that as a golden period where a lot of banks had good profitability, things were relatively stable, the economy was doing well. But let's not kid ourselves. Even in that period, many consumers struggled to manage their money. I'm not going to read out these statistics here, but these came from research that we did, just pre-COVID. Nearly half of consumers claiming that they struggled to manage their money and they didn't understand the complexity. Only a quarter having the cash to cover, 6 months of expenses. Only a third having sufficient savings for longer term financial goals, and less than a third being net savers. So as the financial stress increases in the post-COVID world, these numbers are only going to get worse. So there is going to be a critical role for banks and financial institutions to play to help the consumers and small business customers navigate their way through this crisis. But I think that one of the challenges that financial institutions face is that they haven't been the institutions that our consumers and small businesses have turned to for advice in the past. So this is a question from that recent research. Did you seek help as a consumer in dealing with the financial implications of a major life event? And if so, whom did you turn to? What you can see is about half of consumers did seek help. But of those consumers, over half of them turned to friends and family. Only 28% of them turned to a bank for advice. So you can do the math here. If you think about this more holistically, only 14% of consumers turned to their bank for advice in a period of financial stress. And why? Why did they not think of their bank as their advisor? And I think it's the difference between transactional and advisory trust that is important. Consumers obviously still trust banks from a transactional standpoint. They trust them to look after the money, to keep score, to process payments. And there is clearly still a meaningful gap between that level of transactional trust in financial institutions and everyone else in the economy. And that's why even with the emergence of big tech, the banks still have the high ground in many respects. But if you then ask consumers, do you trust that your financial institution will always act in your best interests in every situation? That's when you get down into the single digit numbers or the low teens. And that is what really correlates with that 14% number. That in times of stress, when you're looking for assistance, do you trust that the bank is going to be there in a way that is going to actually be helpful to you rather than to them? We tried to quantify, I think, some of the dangers in that trust deficit. This is recent analysis that shows across markets, we think about 5% of bank revenue is at risk if they don't address the trust deficit. And it's at risk in two different forms. One here is the smaller sort of grey box on top, which is one form of sort of bad revenue. It's the revenue that comes from customers making bad decisions about how to allocate financial resources and the products to use. So think of this as a customer who keeps too much money in their checking account and doesn't sweep it into a savings account. Think of this as a customer who borrows on their credit card when they could be borrowing in a home equity line. So making poor decisions where better advice may have shaped a different outcome. But the far larger bar here is the purple bar. And that is the purple bar that is related to things like overdrafts, service fees, things where customers and small businesses making poor decisions about how they manage their financial resources trigger some sort of revenue generation on the part of the bank. And we think that these revenues are clearly at risk. They're at risk both from regulators and they're at risk from competitive activity. So if you look at the magnitude of revenue at risk, 5% is the average across these markets. But it's really not surprising if you've been following the Australian financial services industry and the findings of the Royal Commission, that Australia is the top here with 7 to 9% of that revenue at risk, and much of it coming from the regulatory and competitive pressure. Again, not surprising that the UK is next. It has been ground zero for the challenger bank surge that we've seen, with over 20 million customers in the UK choosing to open challenger bank accounts. And part of the reason was their belief that they weren't getting particularly good service or advice from their existing financial institutions. Now, there are counter examples. You look at Japan, where the bad revenue level is relatively low, suggesting that Japanese consumers are significantly happier with the service that they're getting. So the challenge here is how to address this, and we think addressing it comes in two forums. One is what we call Pillar 1 here, which is really doing the right thing for customers, rebuilding the trust, not letting them go into overdraft, not letting them get hit with service fees if there's a way to avoid it. And actually, the irony is that COVID-19 is driving a lot of that type of behavior at the moment from financial institutions. Short-term payment holidays, the extension out for 90 days of credit card or mortgage payments, free overdrafts, interest-free overdrafts if they're pre-arranged in advance. So we think a lot of the things which 4 or 5 months ago we were thinking were going to be key to Pillar 1 are already being put in place by financial institutions. And I think what's going to happen is those things are going to stick. Consumers and small businesses are going to have a behavioral change that says, I expect my bank to help me in periods of financial stress. And I don't think we're going to go back from that. I think the expectation level has risen. Pillar 2 here is what comes when you build on that. It's really addressing the 14% problem. It's really saying what the new trust-based revenue streams that can expand the scope of financial advice so that consumers and small businesses naturally look to their financial institution and to their bank for unmet needs. How can you help those customers build wealth? How can you help them manage what may be a very challenging credit situation? And as you do that, how do you build the trust that you're there to provide advice on an ongoing basis? And it's a prize that's worth having. So what we've done is we've looked at the flip side of some of that bad revenue at risk to say, what is the revenue uplift if you can effectively build that Pillar 1 and Pillar 2 type trust proposition? And as you can see, gain for the financial services industry. Again, you can see large skews by market here, with the UK, Spain, Germany being at the upper end of the range, Canada, France, and Sweden being at the lower end. We've also included here what we call a trust kicker effect, which is we know from looking at other industries, if you become recognized as a trust-based institution, as somebody who has purpose, who does the right things for your customer, then it drives net new customer acquisition. Once that recognition is there, you get an uplift from it. And you see that in a lot of what the challenger banks have done. A lot of the viral marketing that has driven new customer acquisition has come from customers themselves sharing that these institutions are easier to deal with, that they have your best interest at heart, that they're there to provide advice. So we think that there is an uplift, but we think that the challenge here is really not taking the 2020 hindsight, not looking backwards, but instead thinking about this as 2025 hindsight. If you put yourself 5 years out from now, what would financial institutions say in terms of what they wish they had done during this period of the COVID-19 crisis and the immediate aftermath? So I think these would be some of my predictions for 2025, that many banks will wish that they had put long-term relationships before short-term profitability. Profit is going to be challenged. We think that profitability in the banking sector by market will be 20 to 100% down over the next 12 months. So there's the opportunity, I think, to do the right thing. But the mindset has to change from, the sort of gotcha mindset of, we're going to layer on fees to a win-win mindset. And I'll give you an example. A US mortgage servicer complied with, the guidance and has provided 90-day payment holidays, but then sent a notification to its customers saying that on day 91, the balloon payment will come due of everything that you've not paid over the last 3 months, completely destroying any sense of win-win proposition that servicer could have had. Whereas other servicers have said, we will amortize to the end of the loan, we will extend the life of the loan, and we will help you manage through this crisis. I think there's going to be an onus on financial institutions getting creative about building financial bridges. How do you use the assets that you have? How do you use equity in your home? If you're a small business, maybe how do you think about assets that you can borrow against to help you navigate through this crisis, preventing, workout and foreclosure and recovery? going back to some of the things that Hossein said, how do you take this opportunity to truly personalize interactions and really engage in digital conversations rather than broadcasting? I'm not sure about you, but I'm getting a little sick of these messages from CEOs, which are blanket messages saying we're here, we're standing with you, we're here to help, with no level of specificity and no sense of recognition of the nature of the customer that I might be of that organization. So how do we get down from those, feel-good messages to messages that are fact-based, that provide options, that guide towards actions? And that's where I think the regret is going to still be there, that if financial institutions are not using innovative technologies like Flybits to personalize banking, consumers are not going to feel as if they've truly been engaged. They're not going to feel as if the advice has truly been personalized. And therefore, those types of trust gaps that I highlighted earlier are not going to be closed. And I think just the same way as people remember back to the 08-09 crisis, and they remember how their financial institutions treated them, when, say, they fell behind on their mortgage. This is going to be a period where the consumers and the small business customers of banks are going to remember how they're going to be treated in the next 12 to 18 months. And that's why I think, despite the public health aspect of this, which is clearly tragic, I agree with Hossein, this truly is an opportunity for banks to be heroes rather than villains, to step in, to personalize their advice and help their customers through what is truly going to be a challenging set of financial circumstances over the next 12 to 18 months. So with that, Janine, I think I'll hand it back to you.
Thank you very much, Alan. That was a very compelling talk with some very helpful, actionable takeaways for our audience. What I'm going to do right now is just maybe ask you one question, and then what we're going to do is go over to the audience because we've received several questions. So Alan, do you have any examples that you could share today of banks that are actually taking this purpose-driven banking approach? Are you seeing it?
Yes, I mean, I think actually we were seeing it previous to the crisis. And if I look at, say, the success of some of the challenger banks, let's say a Monzo or a Starling in the UK, one of the things that they had was a tone of voice that was very much, we're in this together. So to say, how is it that we can help you achieve your goals? Whether that be segregated savings pots, whether that be the way of tracking your expenditure and helping you navigate that. I think that tone of voice around this is win-win for us. If you do well, you will bring more business to us. You will get into a better financial situation over time, and that will help us. So I think we saw that pre-COVID. I think where I'm really beginning to see it now is moving away from what was primarily a sort of payments and savings set of messages towards a set of credit messages. So beginning to see differentiation in terms of how major providers of credit are reaching out to their customers. So I would take the example of, say, Cabbage in the US as a sort of relatively new small business lender, being very proactive around the Small Business Administration PPP program in the US, the payroll protection, reaching out to their customers, trying to help them understand, did they qualify, did they not qualify? And Cabbage isn't a huge player in the market when you look at total overall credit for small businesses, yet it was the number 6 SBA lender over the last 6 weeks. So I would take that as an example of really trying to reach out and engage with customers and use it as an opportunity to build new relationships and say, we understand the stress that you're going to be under. Let us help you navigate what has been a sort of complex and difficult borrowing process and then help you through this. So I think it's about the specificity, but it's also about tone of voice, and it's also about being explicitly on the customer side of the table as they navigate some of these challenges.
Thank you. That makes a lot of sense. We have another really great question. This could go to either you, Hossein, or Alan. How would you rate the Canadian banks to USA and European banks? Who exactly has the competitive edge on a global comparison?
I spend quite a lot of time in Canada, and I have a lot of long-standing client relationships. I think Canada goes into this crisis in far better shape than many other banking markets around the world. The profitability has been good. There is a capability to invest. Also, Canada has been less disrupted, I would say, from players coming from the outside. You know, when you look at, say, the UK, about 15–16% of the revenue in retail and consumer financial services has already flowed out to new entrants. In Canada, that number is less than 2%. And one of the reasons is that there's still a reasonable amount of trust, I think, in the Canadian banking sector. It's not been undermined, say, the way that it has been in Australia by the Royal Commission findings. So I think what you find is that a lot of the innovation in Canadian banking still comes from within the incumbent institutions. You know, so I think that the ability of the Canadian banks to help the consumers navigate here is amplified, one, by the financial resources to invest, which they have over the last few years, and two, by the level of trust that there still is, so that the consumers, I think, will naturally look to the Canadian banks to help them through this crisis, rather than looking to alternatives. So I think that those are reasons why I think Canada will probably, with hindsight, have a good crisis here with respect to how the banks perform and engage their customers. So I don't know if Hossein, if you have, given your Canadian connections, whether you have a different viewpoint on that.
Being a proud Canadian company, I make sure that there's no bias in my answer, but some of my observations are there's a lot of similarity between what's happening in Canada and the UK. I mean, the structure is that there is this kind of oligopoly between banks and telcos. So when they want to form these partnerships, it's much easier for them to demonstrate impact. Whereas if you think about the large players in the US, they will have more challenges to really surround themselves with complementary businesses and also get the trust by the government and people. There's also another thing that in Canada, banks are much closer to the government. They are, especially these days, they are acting as a very strong proxy between people, citizens, residents, and the government programs. So I think there are unique opportunities in places like in Canada to really demonstrate how banks can really become that hub that I talked about. The counterparts in the US are super regional banks, because if you think about the community banks and the super regionals in the US, they also have that community feeling. So if I kind of want to compare what's going to happen in places like Canada and the UK, that we have very few large banks and very key players on the industry like telcos and energy companies, it's much easier to kind of prove the hypothesis that I shared. In the US, super regional banks like USAA, like PNC, like others, they are in a very strong position to demonstrate that shift.
Thank you. We've got another interesting question here for Hossein. What kind of opportunities, if any, do you see for life and health insurers to build similar ecosystems and engagement opportunities as you described for banks?
Sure. We are actually working with a number of very large insurance companies, and we are seeing some interesting examples there from areas of group benefits that the insurance company actually plays a role in the well-being of the employees. So when, as a company, I go and get a group benefit from a particular insurers, the data that the insurers have will actually drive healthier behavior for employees of that business, which also correlate to the well-being of the SME or the company. One of my favorite examples that we are currently working on is kind of in the wealth space. A bank came to us and said, you know, a lot of my wealth business is based on service fees, and millennials are my next gen customers and they are not very comfortable with that. How do I really transform my business model? So one thing we are working with them is that we are connecting their upcoming segments, which are the millennials or the entrepreneurs and the affluent, who we think they're going to be affluent in the future, with the baby boomers who already made their money. And then we create a mentor-mentee relationship between them, and the bank is the hub for making those connections. Now, you can imagine that this network is so strong, surrounded by a bank known for its trust, that it's now helping young entrepreneurs with their career through mentorship. These are business models that we are seeing that are coming as augmentation layer around core business models, let's say in the wealth business or I also shared an example with you in the insurance business that are very interesting for us.
Thank you. One more question. I think we're getting close to time, but here's another interesting one that came in via email. How do banks continuously demonstrate empathy for what their customers are experiencing? Not just now, but 10 years from now. And then how do they do this on this, personalized level at scale? Is that even possible?
Let me take that. I think one of the things that's going to be key is transparency. And transparency in terms of being able to demonstrate more of a fiduciary mindset. I think we begin to see some of that emerge, say, in the P&C insurance sector. So if you look at the progressive, advertising in the US, let us show you our price and let us show you everyone else's price as well. We may not be the best carrier for you, but help us figure out if you are somebody that we can serve. I think you see that happening in financial services, but you see it mostly, or in banking, but mostly through intermediation. So you see in the US, people at NerdWallet trying to intermediate and trying to say, okay, we can help you get the best deal. I think, to try and get real, empathy and engagement and to be demonstrating that you're working in the client's interest. I think ultimately there's going to have to be a transparency with customers that sometimes the bank is the best option and sometimes the bank is not the best option for you. And I think that, there's a fear of cannibalization of revenue that comes from that. But I think ultimately the KPIs and the mindset has to shift from quarterly, short-term, customer profitability to longer-term customer value metrics, where not only the duration of a customer relationship, but the share of wallet, increase over time is a justification for not always making the sale. And really taking the position of being an advisor. And sometimes the advisor will have the product and sometimes the advisor will not have the product. And I think the true personalization and understanding will not be there unless there's that level of transparency. Because we clearly see from our research that, most customers still believe that when the bank says, here's a product for you to buy, that the bank is working in their interests, not in your interests. And, every time we have a mis-selling scandal, every time we have something like the PPI scandal in the UK, it reinforces that sense that the bank is working in their interest, not yours. So I think, we're not going to get to that empathetic relationship until there is demonstration of win-win economics.
Yeah, that's a really good point. It's really about taking more of a partnership approach versus a sales approach, right? Yeah. Well, with that, we have 2 minutes left. I don't know, Hossein, if you have any final thoughts before we leave for today.
There is one question. I see it on my chat panel. It's a great question. I very quickly want to address that. I think it's a question from Vaibhav that asks about the role of government data. And in the US, we have data.gov, and in India, we have data.gov.in. I think those data sets and really bringing government data and open data as partners and really create curation programs that not just the developer, but citizens can become co-developers around banks will really contribute to the emergence of a lot of new economic models that we talked about. And with that, again, I want to thank everyone for joining us. It's great to be on the panel with Accenture. Accenture is one of these very unique organizations that are doing some very, very unique things in the market. And I'm glad that we had an opportunity to be with Alan today and looking forward to staying in touch.
Thank you, everyone. We're going to send out a follow-up email with the recording so you can share this with your colleagues, and we will definitely invite you to our next Summit Series event in a couple of weeks. Have a great day. Bye.
Thank you. Bye.